You said in a note, I believe yesterday, that you wouldn't be surprised by correction. We've got the correction here for the S&P 500. How are you positioning yourself after the week that we have had?
So, I would just say in terms of the absolute moves on the S&P 500, the point we tried to make yesterday was that if we broke below 3050, which was a garden variety pullback of 10%, there was an important technical level around there, that if we did that, which we did on the close, that we would expect to see a growth scare take hold. And what we mean by growth scare is a drop of about 14-20%, takes the S&P down into the 2700, 2900 range. And, we also said, frankly, that as we had done some back of the envelope calculations on what the earnings outlook might look like for the S&P, that once you breach that 2900 case for the S&P, the valuation froth would essentially be out of the market. We could start to talk a little bit about how stocks were cheap again. So that's where we are. We think we're set up for a growth scare. Today's difficult move in the market, while it is horrible and it feels awful, doesn't surprise me based on how we closed yesterday. Now, I will tell you, I haven't really changed anything in terms of, sort of our sector preferences, our style preferences coming into this. We were telling investors that we like small caps relative to large caps, and we're actually seeing small caps holding up pretty well on a relative basis on some of these downdrafts. We are finding ourselves talking a lot about industrials as well, which already look pretty de-risked in terms of relative valuations. And they've been, kind of middle of the pack here recently. So we're feeling pretty good about both those calls right now.
Hi, this is Nuri Rubini. I'd like to ask you a question. It looks like this is becoming a global pandemic, but in Europe right now is mostly Italy. But given the decision not to essentially close Schengen, anybody can move towards France, Germany, and you name it. I think it's actually a mistake because in 2015, when you had the tidal wave of the refugees, they effectively suspended Schengen. This is a real threat. They're not doing it. So it's only a matter of time until it's going to get to London, to Berlin, to Paris, and you name it. And in the United States, we're not testing almost anybody. And the CDC has said this is inevitable. So it wouldn't be likely to believe that in the next few days, we're going to see more news of this thing going all over Europe, more cases in the United States. And then given that, whether it's rational or not, markets are going to have another significant leg down in the next week or so. Is it unlikely? I mean, isn't it time to be better safe rather than sorry if you are in equities?
Well, sure. I mean, and look, we have also been recommending to people that they buy the utility sector. And, frankly, we have had that position on for quite some time. And we were really reinforcing it earlier this year because we told people that we thought there was going to be turbulence in markets early in the year. So, we have some defensive insurance in our portfolio as well. Although, interestingly, the utility sector is getting a bit beaten up today. What we're starting to see is, some profit taking on those more defensive bits of the equity market as well. What I would tell you is that I have been on the road, pretty steadily since last Wednesday, talking to investors around the country, a lot of different states, a lot of different cities. And I have been hearing, what you've been saying, that it's just a matter of time before it gets here. Frankly, I'm hearing investors have been telling me for the past week they think it's already here. So I do think that markets are an anticipatory mechanism. And to some extent, what is coming is already getting priced into markets right now.
Well, Lori, there was the note from Goldman Sachs in the middle of the week that talked about the potential if we hit a bear market, we'll go further from the 20% that would make a bear market. On average, the bear markets are down about 31%, but then it takes almost 2+ years just to really get a recovery. Are you anticipating because right now on the indexes are down almost 16% across the board, we're approaching that bear market territory. Do you think we're going to spill over? And do you expect investors to have to be prepared for a 2 to 3 year slog to get out of it?
I wouldn't necessarily be anticipating a 2 to 3 year slug, but in terms of, sort of if that 20% growth scare threshold doesn't hold, your next threshold, our next sort of rule of thumb is to look for recession type pricing. And, I think there's a little bit of air that needs to be cleared in terms of how to think about recessions in equity markets. The last two, the financial crisis and the tech bubble, were pretty devastating. The market essentially lost half its value. But if you go back to the 30s, the average and median drop has been about 32% and 24%. And so actually what we did in the fourth quarter of 2018 was coming pretty darn close to pricing in a recession itself. So I would just ask you, if things do continue to spiral, just to keep that 24 and 32% in the back of your mind. Those 50% type drawdowns we saw are really, really not the norm.
Lori Calvasina of RBC Capital Markets, great to get your insight today. Thank you.
All right, thanks for having me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.